first rates will just start pouring in on your screen. And there you go, 57 points higher for the Nifty. It was a okay Monday for the Nifty actually. For the Nifty, it's a 51 point start. The market breadth is looking near perfect. And you've got Adani group of stocks, you've got insurance stocks, you've got Coal India, a whole host of stocks which are off to a good start. So what do you want to start with? Well, let's start with a theme which is defense, and then we look at railways. Adani group of stocks, the AGM of Adani Enterprise, they're talking about how the size of the business is going to change. Defense, HAL 36 rupees higher. You've got BL flat at 122. And you've got Mazgaon Shipyard, which in a sense was like the talked about stock yesterday, both in terms of price action, volume action. Can you believe that it's at 1300 now? Just been a one-way ride for Mazgaon Shipyard. And then last but not the least, you want to look at Reliance and then Infosys. The breadth, I think, is where the real excitement is in terms of the market center.
Oh, yeah, absolutely. In fact, just highlighted Bajaj Auto and IndusInd Bank, especially after that Macquarie note, wherein on IndusInd Bank state that they're confident of increasing their NIMs from the current 4.25% to 4.3% to now 4.4%, although IndusInd Bank is not really seeing any excitement. Let's see what Unilever is up to. Rohit Java takes over as the MD and CEO from today. Unilever as well starts off very, very quiet in trade. Paytm, Macquarie has actually downgraded it to a neutral from the earlier outperform. They maintain their target price though of 800 bucks. 842 is where Paytm is in trade today. AB Capital, the QIP of 1750 crore rupees, floor price 175.99, gets launched today. AB Capital will just come for you on your screens. This was, remember, a big mover in trade yesterday. And then, of course, Sapphire Foods as well, wherein a large trade of 3 million shares is expected in a price range of 13.45 to about 13.91. That's the other stock in focus. And let's see what Parag Milk as well is up to. 6 Cents India, led by Nikhil Vora, has been a buyer. 7.8 shares at 132 rupees per share price point. 135 down tick of 2% on Parag Milk is what you're seeing in trade right now. But yeah, net, once again, a very, very quiet start. Marginally in the green, 18,750 thereabouts. Kunal, where does it go from here?
Yeah, I think it's an okay start for the index. 67 points up for the Nifty. Hopefully that should have a positive effect to the rollovers, which is pending today as well as on Thursday. In terms of the opening stock, the trade which I would look to look out for in the open would be Maruti. I think that's a stock which looks extremely attractive after yesterday's bullish engulfing chart and the recovery in most of the other auto stocks. I think this could be a stock which can see a decent upside even going forward.
Okay, that's Maruti, which is on Kunal's radar. Lots buzzing away within the broader universe as well. Let's find out what Naresh's top recommendation is. Naresh, your first trade?
So that would be another auto name, that Hero MotoCorp. That looks interesting for a structural trend change. So at 2800, 2850 is a good zone to accumulate with a short-term view as well as a medium-term view.
Dinsha Rani is also ready, and let's say hello and good morning to him. Is he joining us with an umbrella in his hand? No. You're dry. You've reached office. No rains.
Yeah.
Half my office folks are struggling today. How did you manage? Please tell us the secret. No umbrella, completely dry. Sorry?
I stay 8 minutes away from my office, so not a problem.
The trick to survival in Mumbai, right? Live close to work.
Stay close to office. Okay. Good job, Dinsha. I must say that. I mean, it's so good to see that you managed on time without an umbrella and you're completely dry. It's been pouring and pouring. It's been pouring gains in the market. Do you think this trend will continue?
Yeah, thank you, Nikhil, for having me on your show, and a very good morning to you, your team, and the viewers. So I heard you before I came on the show. I logged in earlier. You sound very bearish. Never be so bearish on India. That's what we believe.
All I'm saying is that the tree could shake, so some fruits will fall. Now, when the tree is shaking does not mean the trend changes, but maybe it's time to enjoy some ripe fruits. Cherish them.
Yeah, actually, I agree. I mean, there have been pockets of real outperformance which have been running away as such, and probably you can take some money off the table there. But I don't think looking at what we are seeing right now, in fact, you refer to that Kotak report, and if you just before I came in, you referred to that report. If you see a bit more deeper into that report, there the valuation that they're talking about for the market, I mean, they've taken a 24-year average and said that the market looks very expensive. But frankly, I mean, I don't think the last 24 years are really representative of what the markets are. If you look at the valuations after the demon period, which is from 17 onwards, we are there. We are at some 90, just shy of 20 as such. And I think the average is some 19 odd. So we are somewhere there only. And I think that's the kind of representation that you're looking at. And frankly, I mean, look at the flows. We've done almost 12 billion in the last 2.5 months, 3.5 months or so. But the fact is that India is standing out today, not only in the region, thanks to what's happening in China. In fact, China is nowadays being related to the late 80s of Japan. I mean, they're talking about a property bubble, which means a bust, and China may go sideways. And frankly, I mean, the opening trade never worked out in China. So fairly unhappy with 1/3 of the market, which is commanded by China. I mean, as in I'm talking about the flows in emerging Asia region. So that, and plus you look at the other markets also in the region, they're not doing too well. In fact, India stands out. In the last 3 months, we're the best performing market in the region, probably the third best performing in the world. And I don't see that trend reversing, frankly, because of the intrinsic strength that India has to offer the world as such. And obviously, I mean, the kind of outperformance which has happened in the last 3 months or so, maybe there'll be a breather, but I don't see a big correction coming.
Then, so what could be the trigger now?
For the markets to move up, you're saying?
Yes.
Okay, so basically, I believe that one is, as I said, that maybe there'll be a breather on the side on going sideways. But I mean, trigger as in you're still seeing flows coming in. I don't think there's a reversal though in the flows. And plus, I mean, the quarterly numbers which are coming in, I don't think probably there'll be pockets of again within the numbers, there'll be pockets where there'll be disappointment, because I don't think people have still discounted the fact that IT will go through the worst quarter reported thus far. And I think there'll be some disappointment there as such. But others like banking and all, I don't see any problems there. Financials have done fairly well. Consumption continues to do well. There'll be some discretionary consumption spends which have taken a backseat, so that may have an impact. But frankly, I mean, you don't need big triggers in the market. You just need the world to stabilize, and if that happens, that's enough for India to continue their outperformance per se.
Let's look at the market setup. Everyone is excited to own financials, and financials have done rather well. Banks do well when interest rates are moving higher, at least in the first phase, because they get benefits of lower deposits, higher credit growth. How do you see banks moving now that interest rates have peaked out? Because interest rate movement in last 12 months has been the biggest moving part.
Right. So, Nikunj, actually, we've been also breaking our brains on this, but we were pleasantly surprised by the way credit started moving. And actually, that is what is needed. Let's remember that there have been 3 cycles of private capex which have been postponed. Initially for the elections, then came demon, and then obviously came COVID. So you're seeing this 3 cycles working out. If consumption continues the way it is, I think these cycles will work out perfectly for the banks per se, because they're not only going to fund the consumption, but they're also going to fund the capex which is needed to take care of this consumption growth. So banks will, in fact, the NIMs that you talked about, we also felt that they've peaked out as such. And frankly, I mean, the March numbers were a pleasant surprise because they didn't peak out. In fact, some of the banks reported a further expansion in NIMs per se. But our feel is that they more or less peaked out. Maybe there'll be some inversion there as such. But the fact is that if credit growth picks up, then we are home and dry, because that's where there's the other pillar of growth for the banks as such. And if that kicks in, I think we'll be more or less taken care of. And in fact, just remember that when actual businesses grow, and obviously credit growth is an intrinsic part of the business for these guys, then that's when the re-rating happens as such. So I don't think we have a concern on the banks front.
Dinshabu, what do you have to say about the narrow nature of this rally? Your traditional heavyweights not participating. It's a newer leg of names which is actually taking the market just about close to an all-time peak.
So Aisha, I don't know why you call it a rally, because we've seen year to date only 2.7% growth or 3% outgrowth in Nifty, right? We getting carried away by the last 3 months. where the run has been around 11 odd percent as such. So I think it's a matter of time before some heavyweights may kick in. I don't obviously IT won't be a part of that pack as such, because I think they're having a serious problem going forward as such. So that won't be the case. But obviously there'll be likes of other which may just kick in at some point in time, because ultimately what markets are, it's a race. You need a set of leaders to take over the baton whenever one lags. So there'll be pockets which will come up as such. So I don't see any problems here.
Ninsha, hi, morning. And if you've been listening into Nikunj, I'm sure you heard the ITC interview as well. Lots of key takeaways, but among that being talking about, the kind of potential for FMCG as a whole in the country. What would be, your outlook in terms of FMCG and where the potential lies?
So, Aman, the point is that FMCG per se, I don't think we are that keen on, though we own ITC, by the way, but it's not for the FMCG business. It was mainly for the tobacco business. We got into ITC because it's a inflation hedge, plus obviously the fact that it was an opening trade, because smokers normally don't smoke at home. When the office is open, they come to office and start smoking. So that was a perfect trade that worked out for us in a big way as such. But FMCG part, I don't think we are that keen, frankly, because ultimately, when you're looking at valuations, they have to be in sync with the growth rates, right? They have to be normally they are directly proportional to growth rates. So if your growth rates are, earnings growth are high, valuations will be high, right? But in the case of FMCG, it's the other way around. The earnings growth are not that high. I mean, they're probably at best early double digits, like 10, 11% odd as such. And the valuations are at peak levels. So we're not that keen. And frankly, I mean, if the economy picks up, we're not going to see people taking bath 3 times a day or 4 times a day, right? So there's a limit to which you can give valuations to these stocks. So we are not too keen on the FMCG space.
Gives you the conviction to still hold on to, let's say, some of your traditional favorites, Vedant Fashion, Indian Hotels, Westlife, Titan. By any yardstick, these are expensive.
Yeah, but because you rightly put it, so basically, I mean, okay, let me talk about these sectors per se as such. And frankly, I mean, we're talking about discretionary spends out, the ones which you took names of. So we're also cognizant of the fact that the valuations have run up quite a bit in most of these counters as such. So we're being careful here. I don't think we're chasing these counters. But the fact is that when you build a portfolio, you're looking at the overall portfolio rather than looking at individual stocks where you know that there's an alpha built in, right? You know that these alpha will kick in as and when the economy picks up as such. There'll be times when they'll be lagging as such. Again, as I said, you're running a relay race, right? So overall, our peg for our portfolio today is less than probably 0.6 times or so. So we're more or less comfortable with the way we've built our portfolio. And obviously, there'll be these kind of spicy stocks, if you may call them, as which may add some flavor to the portfolio going forward. And I don't think we are very concerned about the hotel space. I think that's got a long way to go. But the other stocks that you named, obviously the valuations are a bit of a stretch. But again, the growth rates are fairly high.
Okay, thanks so much then for sharing with us your outlook. Then sure, good to have you on ET Now as always. All right, and here's that mega exclusive as promised. Let's hear our ITC Sanjiv Puri as he talks about what's in store for the diversified giant.
Grit, perseverance and patience, all 3 things which really define Sanjiv Puri as an individual. His tenure as chairman of ITC has been full of twists and turns. When he took over as chairman of ITC, the the cigarette business was plateauing. The FMCG business did not reach scale and size. The paper business and the hotel business was going through a cyclical downturn. But today, ITC is firing full cylinders. The shareholders are mighty delighted that the stock is at an all-time high. return ratios are speaking for themselves, and he's managed to turn around most of the businesses. So what is the secret sauce? What is the binding force which is connecting ITC, a diversified Indian conglomerate? And we are here at a mega factory of ITC to understand that really the journey and the process and how ITC is becoming future ready. Welcome to See You at Work. I am Nikunj Dalmia, and ET Now is coming from a mega factory of ITC. And it is indeed an honor and a pleasure to have the man himself, Mr. Sanjiv Puri, Chairman of ITC. Thank you so very much, sir, for having us on the show. Thank you.
Thank you, Nikunj, for coming here. Always a pleasure to interact with you.
So we are standing in what looks like an industrial factory to me, and I've been told that it just produces everything which I consume on a daily basis: chips, juices, and lovely chocolates and sweets.
Yes, very much. It's a foods factory. It's one of our larger setups. Just to give you a little dimension, this facility has more than 1 billion square feet of built-up area. It's an integrated consumer goods manufacturing and also logistics facility. And we've been building such facilities with a strategic plan of creating structural advantages for our business. And from this facility, for example, and such other facilities, we have multiple dimensions of such structural advantage. First and foremost, to win in the market, our strategy has been around product differentiation, product quality, and product quality is very, very critical to us. And also being able to deliver to the consumer at the lowest cost.
So let's first look at the big picture in terms of the revenue. The tobacco contribution is coming down, other businesses are moving higher. The tobacco business contribution is less than 40% now. As the chairman of ITC, are you satisfied with this kind of a diversified mix, or you need to bring the tobacco revenue further down as percentage of the total kitty?
So, you see, you're right. Our non-cigarette revenues are about 2/3, and non-cigarette EBITDA is also now 28%. It is becoming significant. And all these are growing faster than the rate at which the overall company grows. And today 80% of our capital employed is actually in the non-cigarette sector. Okay, that's where the investment is. So from our perspective, it's about providing industry leading performance in each one of the segments. That is the objective. It is about leadership in every segment, not merely because of size, also on account of product or the services. We want leadership. So where we are already leaders, the idea is, can we progress further? Where we are not leaders, we need to become leaders. In some of the newer businesses, some categories, we may not be leaders. The idea is to become leaders there. So that's the way we look at it. But because the opportunity and our investments are aligned towards the newer segments, naturally over time, I think they will grow faster. They will occupy a bigger salience in our whole kitty.
So, Mr. Puri, when the FMCG business of ITC was incubated, everyone said the cash flow of the cigarette business is going into a low margin business. And if the FMCG business is demerged, the ITC tobacco business will be re-rated. But do you think in the future, FMCG business, the fact that it has got incubated, would actually add more value to the shareholder rather than dragging the return ratios down?
See, FMCG is a sector that has got immense promise in India. Given the per capita incomes, given the penetration level, it's got immense potential. We have in fact crafted a portfolio, and we are building a portfolio where there is huge headroom to grow. Analyst points out that we have the largest addressable space of 5 lakh crores by 2030. That's in what we have. But as we go along, we will add more things also. Right? So it's a continuous process. So there is huge headroom to grow there. And it's a business that we have into in many spaces. Foods is our largest space. We are also into stationery. We are also into agarbattis. We are also into personal care. So there are many dimensions of growth we have here. And we believe that this will be certainly be a lot more value accretive with passage of time. We have seen in the last, medium term itself that not only has the today our size is 1.5x of pre-COVID. Over a medium term, our margins have expanded by 770 basis points. ROCE has gone up by 1340 points. And we are not there. We are not done as yet. The journey continues. We believe that we will expand margins by, aspiration is 100 basis points every year. So there's a lot of opportunity there. And we have laid a strong foundation with our trademarks, with our innovation capability, with our digital capability, with our distribution highway. We have not really tapped the potential of exports. We've just started in the short term to put the distribution apparatus in place.
So some of your brands can actually be exported, the one which are made in India.
We are already exported to 60 countries. But the headroom to grow is huge because it's early days.
So just to bring that point again on the FMCG business, you are in the top quartile, certainly top 3 in terms of top line. But in terms of profits, you are not there. In terms of margins, you are not there. When do you think you will be able to reach the top quartile from an industry standpoint? 3 years, 5 years, or more than 5 years?
So let me give you a little perspective on this. Our FMCG business includes a lot of gestating costs for facilities like this, which are designed for scalability, incubation of newer brands. There are certain older brands that are big, and because the older brands are able to make more and more surplus, they are able to offset the gestating cost here. So we are improving, and we will improve by 100 basis points every year.
Okay.
And what is it that will? I think one more important is what is it that is going to give us this 100 basis point? On one hand, it is premiumization.
Okay.
And what do I mean by premiumization? It is about premiumizing within the same category. Examples being Fiamma Naturals range, examples being Chocofil's Desert collections.
Chocolate has become that big for you.
Yes, it's a big brand. It's a big brand, and we also have a Desert collection now.
Okay.
Then it's about using the large brand to address more value-added adjacencies. Dark Fantasy is also into milkshakes. Ashirwad is into frozen breads. It is into fresh paneer. It is into ghee, and so on and so forth. It is into rava, besan, vermicelli, all value-added adjacencies. And the third piece is, India has also become a very aspirational society.
Yes. Yeah.
Bharat is premiumizing. So here it is the challenge here, because the requirements are low there, is to have that kind of supply chain to be able to service Bharat with premium products, and yet because largely they are food products, to make them remain fresh. So we've got some innovative supply chain solutions there. And the cost side, also we are pressing the accelerator high. One is, of course, naturally with the economies of scale and scope we will gain. The other is, I gave you this example of this facility itself, how we are optimizing logistics, how we are delayering operations, how we are integrating not only logistics but back end, and then digital. Digital is becoming a very effective tool to optimize our operations, remove costs in facilities, in logistics, and in sales. And in sales because it leads us to better effectiveness. Just between last year and this year, our sales effectiveness has improved by 17% because of deployment of multiple digital technologies. So there are many things that we are working on, and we will.
The pieces are all coming together.
Yes.
So, Mr. Puri, what we understand is that large part of FMCG capex, the critical capex, is over. The business is now cash generation, which is generating free cash flow. So, can one assume that now you'll have more cash in your kitty, so dividend payout ratios will improve. You don't need that much cash because most of your businesses are now self-sustaining.
Already we have a very handsome dividend payment policy.
It can always increase more.
80 to 85%.
Yeah.
I think the balance we certainly need as growth capital, because it's not merely capex. It is also, for acquisition. Inorganic growth is another vector that we have identified. So both we have to service. And let me put it this way, that earlier our capex was maybe much higher as compared to the size of the business, because we were building the foundation and we were building for scale. Now,
Okay,
also
sir, we can actually pick up a biscuit here, and I must say that
we will
this is,
continue to invest.
I must say, some mom's magic, right off the shelf, right?
Yes, absolutely. But let me finish the piece on
Yes,
capex.
please, yeah.
I must finish it. See, now we will. It's not that we are not going to invest. We will invest,
Yeah.
but it will be more calibrated and in the context of growth and size, and of course technology upgradation and so on and so forth. So at a company level, last year we launched 5 facilities. Construction of 3 more have started this year. 2 are food plants,
So you already have 11.
11 ICMLs.
Okay.
The 5 is across businesses.
Okay.
Okay. So now we have started 2 food facilities and 1 facility for sustainable packaging.
So
ICMLs, yes, we have 11 of them.
the fact that what capacity you've shared with us and the fact that how much these ICMLs can be scaled up to, you are really confident of the market and demand growing, because if you're investing and with the ability to expand in the future, that means that you really expect the categories you represent, the growth is not going to be incremental, it's going to be exponential.
The idea is to continuously deliver industry-leading growth, and what gives us the confidence is that we have established the right
So
to win.
industry-leading growth is incremental. The capacity you're building is telling me that you're preparing for exponential growth.
Well, it's like this. It's like this, that while we create the civil infrastructure, the line addition is in consonance with the market growth. Okay, that's how we do it. Because in a food factory, it's not a smart idea to keep on constructing.
Right.
So a lot of hygiene standards have to be very, very strict here. So if we are to scale up beyond what we have constructed, it will be a completely isolated construction, adjacent but isolated. Right. So that's the point I'm making. Capacity addition will happen.
Okay. So before we move from the another unit, from biscuits to chips, everything is in one unit. I told you I've come with a hungry stomach to the ITC unit. What are the new businesses which you're incubating, which you think in the medium term, 3 to 5 years, will add at least 1,000 crore of top line?
Okay. So I will tell you in 2 parts. Let me tell you in FMCG, and let me tell you some completely new categories. So businesses in the medium term that will scale up are newer categories that we are incubating. One are certain adjacencies that Ashirwad and Sunfeast are getting in. 2 are newer categories like beverages and juices. 3rd are categories like the frozen snacks or the frozen range. It is gone into frozen breads and snacks and so on and so forth. Out of that, for example, in personal care, it will be categories around hygiene that we are building, categories around floor cleaning, Nimile that we are building. Within FMCG, there are categories we are scaling up and categories that we are addressing and categories that we are establishing right to win, and we will scale up in future. At some point, we will also scale up chocolates. Right now, it's in incubation phase. Outside of what we are doing today, but it is in a way connected to our enterprise strengths. So what we have said for ourselves is that wherever enterprise strengths can be leveraged to ride on a trend of digital or sustainability, which are mega trends of the decade, we will be in those businesses. So there are 3 we have already started executing with an encouraging. One is what we call ITC Mars, which is a platform, a digital ecosystem to empower farmers, usher in next generation agriculture, adds to competitiveness of agriculture, competitiveness of foods business, and on its own, it's a business model. That is one. The second is sustainable packaging. The world is moving away from plastics. So we are already in the market with products that are made out of board. Now we are investing in a plant to make molded fiber-based, plant fiber-based products, complex, highly engineered shape.
The coffee cup is going to be not made up of plastic, it will be made up of a plant extract.
That is already done.
Okay.
That is already done in our paper board.
Okay.
The only thing we have done is we have replaced the poly coating with a bio-seal.
Okay.
This will be a completely different category altogether.
Completely eco-friendly.
Completely plant-based fibers.
Plant-based.
The third area we are looking at, again, synergy between foods and hotels are our cloud kitchens.
Interesting.
We
Very
have,
interesting.
we have four cloud kitchens in Bangalore, 4 brands,
Okay.
17 kitchens.
Okay.
So you can put it 4 into 17 outlets.
Okay.
Done quite well. Now we have decided to build the tech stack,
Okay.
prepare ourselves and take it beyond Bangalore. So all these businesses, I think, have got potential to be over time big businesses.
And they can potentially add 500 to 700 to 1,000 crore turnover in medium term.
Yes, all of them have the potential. All of the potential is there.
So, Mr. Puri, let's divide the businesses into a curve. That's what business cycles are. They start young, they reach a teenage growth phase, then mature, and then they start declining. Tobacco, which phase of the curve you are in?
See, as far as tobacco is concerned, it is certainly a mature business. Let me explain it. You see, legal cigarette consumption is only 8% of the full basket in India. Illicit is equal to 1/3 of legal industry, right? So really, as far as that business is concerned, is really the interplay between illicit and the whole basket of consumption, right?
Do number, ek number.
And the larger basket of other formats of consumption, most of which are also, made in unorganized sector. They evade regulatory and so on and so forth. So it's the interplay. In a stable taxation situation, we have seen, not only in the recent past, but earlier also, that the industry is able to claw back and industry is able to grow. So that's the determinant of that. You see, last year we know, if we go back to 18-19 also, when there was stability, revenue went up of the government went up 10%. Earlier, in a period of few years where the growth was of tax rate growth was 15% plus, revenue growth was under 5%, right? Because that time illicit took a jump. Okay, so I think it is really that interplay that will determine how much or this category will grow. But remember, it is only 8% of tobacco basket consumption. And in stability, evidence has shown, data has shown, some gain to legal industry, as you said, number 2 to number 8 happens.
But do you see that change, which has happened over the years, 1%, 1.5% every year? Can that be suddenly 3-4% because of government intervention? We understand number of raids and other checks and balances are in place. Could there be 3 years of very rapid market share? For example, when GST came, a lot changed for the unorganized economy. Do you see that change happening in the tobacco industry?
With stability, and also, I think I must also congratulate the policymakers for the focus on enforcement. I think deterrent actions, both of this are certainly aiding the growth of the legal industry. Now, in that situation, I think industry will grow.
Okay, the hotel industry, boom like never before, occupancy rates like never before. Sanjiv Puri has said at the AGM that we will divest the hotel business at the right time. And when there is a boom time, it's always a good time to divest. Why don't you divest now, sir?
First of all, let me first say that I didn't use the word divest. I said alternate structure.
Okay.
We are not exiting the business,
Okay.
right? Because it is important for us also from a synergy perspective. There's a lot of synergy between foods and hotels, for example, right? So we are saying we will look at an alternate structure. We held it back during COVID period. Once the COVID is over, we have said that it is back on the table in line with industry recovery dynamic. And some time back on a similar question, I had said, yes, industry has recovered, so it is very much on the table, and it will be taken forward maybe in a couple of quarters and things like that. So it is very much on the table. And let me also tell you that besides the synergy, let me also say that while the hotel industry is doing well, I think the opportunity in India in tourism is immense. Economic multipliers are immense, and for the first time, the Honorable Finance Minister in the budget brought out a very clear vision, very powerful vision of creating 50 centers of excellence. I think and that is fundamentally because there is a huge potential, huge economic multiplier, and so we want to scale up, and that is why we have adopted an asset-right strategy, combination of management contracts and whatever assets we are building will help us grow faster. And we are adding almost one hotel a month.
But Mr. Puri, 2019, when you mentioned the fact that you are looking at creating alternative structure, not divesting the hotel business, the lay of the land was different. The capital requirement was different. FMCG cash flows were different. Could there be a case that you may not consider creating an alternative structure for the hotel at all? Because the things have changed after when you spoke about it first versus now.
So our strategy for hotels has not changed. Okay. When I spoke about it, I spoke about asset right in first time in 2017.
Yes.
And we are staying the course. Whenever you look at how you organize yourself, you have to look at your business strategy and look at the pros and cons of the alternate structures that you have got. And our position is the same as what it was earlier. With the asset right strategy, I think an alternate structure is best for creating sustained value, and we will create an institutional mechanism to make sure that we continue to leverage the power of synergy.
Mr. Puri, if you have to use that bell curve to understand where businesses fit in, the tobacco business, cigarette business comes in the mature curve, but FMCG business, which is a 20,000 crore turnover business, you're in the top top quartile now. Would you still say it as a young and a high growth business for ITC?
Absolutely. See, in the categories that we are into as of today itself, I said our addressable space is 500,000 crores. And there are more categories that we will be getting into in future. It is also our youngest business. It is also a business where per capita consumptions, penetration levels in many categories of branded produce is limited. The huge headroom to grow, no doubt about it. And that is what is making us invest and build up for scale in future.
Did you get excited when the stock crossed 400 rupees and made a new high?
Well, it is always nice to hear that, because ultimately it makes all stakeholders happy, it makes shareholders happy. But always we must come back and understand that the role of management, and this is something that it is so irrespective of where the stock price is, the role of the management is to put our heads down, roll up our sleeves, to build competitiveness, think about the business tomorrow and day after, and of course the here and now and today, make sure we deliver competitively superior value, and we leave the market to determine the value it is. So yes, it feels nice, but the task for us continues to be the same, continues to be building businesses, getting them to the next level of growth and the next level of performance.
We are standing in what looks like an industrial factory to me, and I've been told that it just produces everything which I consume on a daily basis.
Yes, very much. It's a foods factory. We're daily shipping out between 50 to 60 million packs a day. This facility, for example, last year shipped out about 100,000 tons of products. It's a digital factory, so all optimizations are possible. It removes one leg of logistics because products flow seamlessly to the warehouse and are shipped directly to the distributor.
All right, there you have it. That's an exclusive slice of the conversation with the top management of ITC. Moving right on then, just a quick check-in on what the markets are up to. For now, we're holding on to the 18,720 mark. It's the broader markets yet again, which seem to be outperforming. And in terms of the frontline gainers, you've got the likes of HDFC Life, Apollo Hospitals, as well as DV's Labs, M&M. Those are some of the smart movers in today's trading session. But let's get a move on then and focus in on some more updates and news. And we understand that the SGX Nifty has now, of course, been relabeled as Gift Nifty. And the SGX Nifty will now look at garnering a lot more investor interest from international waters. Let's connect with V. Balasubramaniam, who's the MD and CEO at NSE International Exchange, to discuss this and talk a little bit more about the plans. Thank you so much for taking time out. Just tell us a little bit more about the plans now for Gift City in Gujarat with the NSE International Exchange, because it's a fully owned subsidiary of the National Stock Exchange.
Yeah, good morning to the viewers. So as you know, NSE International Exchange is a wholly owned subsidiary of NSE. And we are actually now embarking on this full culmination of this SGX Connect, which was launched by Honorable Prime Minister last year on July 29, 2022. And from July 3, 2023, which is Monday morning, 6:30 a.m., the entire liquidity from SGX on the Nifty contracts will switch over to the NSE International Exchange, and all the matching will start happening here. And the entire open interest of close to about $7 billion on the Nifty alone will completely move over to the exchange in the Gift City at the NSE International Exchange.
I'll ask you a simple question on behalf of viewers. Our day starts early morning by tracking SGX. And
Right.
post 3:30 we track SGX. Even on holidays we track XGS to understand that what is happening to Nifty. So what happens to that instrument? Can you explain this to our viewers?
Yeah, so basically SGX Nifty is going to be renamed as Gift Nifty, which we have completely retermed it as. And effectively the offshore contract, which international investors access, which is traded in US dollars, is now going to be available on the listed exchange in the NSE International Exchange. So nothing changes for the international investors, nothing changes from a trackability perspective. Instead of now looking at Singapore exchange as the venue, now you will be looking at the NSE International Exchange at the Gift City as the venue to track this particular market and this product. The trading timings, the trading hours will remain the same. We'll start at 6:30 a.m. India time every day, and we'll go on till almost 2:45 a.m. in the morning. So effectively, the trading is split over two sessions. The first session starts at 6:30 a.m. morning and goes on till 3:40 p.m. in the afternoon, which is when the Indian markets close. And the second session starts from around 4:45 India time, that is the afternoon, and then it will go on till 2:45 a.m. in the morning. So effectively, 21 hours of trading non-stop will be available on this particular instrument. And we are talking about 4 Nifty products. We are talking about the Nifty Index, which is the gift, which will come as part of the Gift Nifty product branding. So one is the Nifty Benchmark Index, the Nifty 50. The second is the Bank Nifty. The third is the IT Nifty, and the last one is the Fin Nifty. All these 4 are envisaged to be covered under this SGX Connect arrangement with Singapore.
Understand, Bala, what happens to the existing OI of the SGX Nifty?
So all of that will move over this weekend, and everything will kind of migrate to the exchange at the NSE International Exchange. So the entire $7 billion of open interest, which is outstanding as of now, will completely move over to our exchange here. So it's called a full liquidity switch. And going forward, SGX, through its special purpose vehicle company called the SGX IFSC India Connect Limited, which is a trading member and a clearing member at the Gift City on our exchange in the NSE International Exchange, will start routing all the orders from the international clients into our exchange.
And what are the contracts available for trading? We understand there are a bunch of sectoral Nifties as well.
Yes. So as I just told you, 4 indices are going to be covered under this arrangement. One is the Nifty 50 benchmark index. The second is the Bank Nifty. The third is the IT Nifty, and the fourth is the Fin Nifty.
Historically, SGX in a sense has always challenged the underlying Nifty volumes, and that was a concern which was raised. Now that SGX Nifty will be GIFT Nifty, what changes in life of a trader or an investor?
So primarily it is a win-win arrangement. That is the way we are looking at it. And primarily it is also to fulfill the agenda for the IFSC, which is onshoring the offshore. So effectively, whatever was available offshore, where we lost control over our pricing, now it is moving into our own jurisdiction. And here this market will be supervised by the IFSC authority, which is the oversight regulator. And this is basically the IFSC is completely from a FEMA perspective. This is all the participants here are non-residents, and effectively Indian companies or Indian broking firms can establish the full-fledged subsidiary and can participate here. So effectively, there are a lot of players from India who will also be moving here. In fact, as we speak today, there are close to about 62 brokers which are fully ready to operate on the platform, on our platform on the exchange. And additionally, Singapore Exchange has its own members, and all of them will be eligible to also route the orders through their SPB company into our exchange. So effectively, now we are looking at broadening the liquidity, and the defragmented liquidity will now kind of all become will all come at one single liquidity pool, and so it's going to be a much larger, broader market, which is what we are going to look at now.
To STT,
to give you a sense of scale, in India, for example, the total open interest on Nifty is close to about $1.5 billion to $2 billion. And here we are talking about 7 billion notional open interest, which is going to be here. So this market is much larger.
Okay.
Secondly, what is also the advantage in this particular jurisdiction is that for non-residents, there are no capital gains. Secondly, there are no STT which is applicable. There are no stamp duty which is applicable. So effectively, it becomes tax-wise, it becomes much more advantageous for non-resident players. And all the entities from India which set up a subsidiary are also treated as non-residents, and they are also exempted from this tax.
And currently, just to clear the air here, again a very basic question. In the current SGX Avatar, what are the taxes which are applicable? Because if you come via GIFT Nifty, you don't pay any taxes. But currently, what taxes do you pay?
So typically in SGX, the way it is traded in SGX, offshore, none of these taxes apply. So what we have done is we have completely kept the same tax neutrality. Whatever is applicable to the international players in terms of whatever taxation they were eligible to pay in Singapore, the same thing is now extended from the IFSC jurisdiction.
Do you think because of this, the volumes for SGX per se, the instrument could go higher? It could be an incremental change, but it will keep on going higher?
Yes, because naturally now there is additional liquidity pool which is going to get created, because many Indian players could not probably access Singapore. So now they are all eligible to come and to the IFSC, and there is a very clear RBI, ODI and OPI guidelines which allows Indian broking entities to set up full-fledged subsidiaries and which can continue to do prop business, and they can also look at taking international clients and even NRIs as clients. So effectively, all these are additional pool of players who are going to come into this particular market. So obviously, the liquidity pool is expected to become much more deeper and larger.
Broadly, SGX would trade for 21 hours, 20 plus out of 24 hours. Now, it is not connected, but indirectly, could this be an indication that soon the exchange time will be extended?
No, it is the same 21 hours. So effectively, the whole market from is now going to migrate into the GIFT City. That is basically the whole construct of this current arrangement. So nothing changes for international players. Earlier, they were routing the orders into Singapore Exchange, and the matching used to happen in the Singapore Exchange. Now, the matching is going to shift from Monday to the NSE International Exchange at GIFT City, and Singapore Exchange, instead of becoming an exchange, is now through a special purpose vehicle company, becoming a trading member of our exchange. So effectively, the whole market is migrating from Singapore location to GIFT City, which is basically what will happen from Monday.
Somebody is US domicile, they would come via Singapore.
Yeah.
Right now, they would come directly to the GIFT City, which means you definitely will get a currency transaction advantage because your dollar will get converted into Sing dollar and then it gets matched. Right now, it will only one transaction which will happen in the local currency.
So Singapore is although they have a Singapore currency, the own currency, the SGX, the Singapore dollar, but effectively the trading was happening in US dollar even in Singapore exchange. But in NSE International Exchange, again, the same US dollar is the currency. But the one more thing is that NSE International Exchange has also got the CFTC Section 13 and Section 30 exemptions. So effectively, US customers can also come directly into the NSE International Exchange.
Wrap it up with one final question. You're starting with 4 instruments. Is the scope of this increasing to, let's say, 6 or 8 in 2 years?
So NSE International Exchange, apart from these 4 instruments, also trade multiple other instruments. We have a single stock futures, which is single stock futures and options, which are available in the Indian market. All of these contracts are also available in the NSE International Exchange, but these are right now not extended into the SGX Connect arrangement. So those who come through the Connect arrangement are limited to only these 4 index contracts. But those who are direct participants on our exchange, they are eligible to trade multiple other products. Apart from derivatives, we also have something called the NSE IFSC receipts, which is something of interest to even Indian residents. So basically, under the LRS framework, every Indian is eligible to take out $250,000 US dollars per year and invest in the international market. So now what we have done in the NSE International Exchanges, on the top 50 New York Stock Exchange and NASDAQ stocks, the US stocks, we are now brought them on a unsponsored DR form. And these are now available as NSE IFSC equity receipts. This is again another product which Indian customers could also be availing through us, and that is through the LRS framework.
Okay, Bala, great to have you on the show. Thank you so much for taking the time out and speaking with us today. That's all that you need to know on the GIFT Nifty, erstwhile SGX Nifty. Let's move on and let's now discuss the texture of the market. By the way, after a quiet start, we have somewhat picked up just a wee bit and then flattened out yet again. So let me take it across to Kunal and Naresh, find out what they've been spotting on the charts. Kunal, you go first. What's on the chartbuster list?
Well, that's a chart on Escorts, Kubota, and how the stock has moved into a very stepwise kind of an uptrend for itself. So this is the March lows for Escorts when the stock was at 1850 odd mark, and from here the stock has been forming a channel pattern on the upside. Now, interestingly, after every phase of a rally, so whether it started off on the in the month of April when the stock moved up from 1800 to 1950 mark. After a 10% move, the stock went into almost a 2 weeks of consolidation. Then from 1950 to 2100 approximately, the stock went into again a similar 10% up move, but then again 2 weeks, 3 weeks of consolidation. And right now from 2100 levels, the stock is almost at 2200 plus mark. Again, a range of 2 to 3 weeks of consolidation. So I'm expecting very similar kind of a breakout for Escorts about the 2200, 2220 mark, and possibility of a retest of the previous highs just above that 2300 level. So very interesting chart, a very systematic and a synchronized manner of uptrend for Escorts.
Okay. Naresh, what about your chartbuster idea?
So that's a chart for Hero MotoCorp. Looking at it on a very longer term time scale, look at it from 2014-15. The stock used to be at 2800 levels in 2014. It was there in 2015. And since then, for the last 8 to 9 years, the returns have been zero. Now, if you look at the last 2 years, every time the stock has come to 2900, it's taken a flip back, and that's a major resistance. The only returns which have come from the stock is in terms of dividends. If you were to look at dividends, over the years, a lot of dividends have come in, but still the return for the last 6 years is also zero. Now, can this be a long-term trend change now? This is what is the possibility we are looking at. And we've seen this happen with a lot of auto names. We've seen Mahindra and Mahindra go through a longish phase of zero returns from 2015 to 21 and then got into a rally. A very similar structure here for Hero MotoCorp. So expecting this to eventually break above 3000, go towards 3600 to 4000 levels. A buy at current levels as well as an accumulated stop loss at 2750.
Let's get some stock ideas as well then, Kunal.
GIC Housing is the first stock which I would suggest as a buy. The stock is on the verge of a flag pattern breakout. So targets of 197, stop loss at 183. And PB Fintech is doing exceptionally well. I think it's now crossed the 700 plus mark. So keeping a stop loss of 688 would suggest a buy for a revised target on the upside of 750.
Right. Naresh, what about your stock list?
So first would be a buy on BHEL. The stock is structurally looking interesting. Stop loss at 82, target price of 95. Second is a buy on Tata Chemicals, a preemptive buy here, very close to the breakout. Stop loss at 970, target price of 1100.
Anuj Poddar joins us now, management of Bajaj Electricals, to understand that how unseasonal rains and commodity prices have had impact on the business for the quarter gone by. Good morning, Anuj. Thank you for joining us. So finally, it's raining, finally, but it has rained late. How has that affected your business?
Morning, Nikunj. I know everybody's happy with the rains. I can't say the same for us. We like the heat to sell our products. But to be honest, it's been a very, yo-yo season for the last 2-3 months with unseasonal rains to different patches in between the summer months. And we've seen that, therefore, yo-yo demand. It's been very difficult to plan. That said, we've had some very intense heat waves, particularly in June, till the recent rains. If I were to sum up this quarter, I think April, May has been soft, but June has seen very strong tertiary demand. And while that's not translated to primary demand, I think that's yet good news for us, because when the tertiary happens, I think the primary will follow in time to come.
Anuj, were you able to take that impending price hike though for fans?
That's been on since about January. I don't think we've all managed to take price hikes the way we need to. So I think with the demand being under pressure, margins have been squeezed. But I think these are cyclical factors. If the overall demand is picking up like we're seeing in tertiary now, then I'm happy for that. Actually, I want to call out another data point, and this is the headline for me in the last many months. I've been saying this for a long time, that GDP has not been translated to consumer demand. We've all seen consumption demand being very slow for several quarters. The best and the brightest news that I've got in a long time is the employment data. And, the May data that's come out for CMIE shows employment, which is the salary jobs, having touched 92 million in May. And it's the first time that we've crossed 90 million since 2019. So that's the one single biggest positive news that I've seen in a long time. And in time to come, that should actually hopefully translate to demand pickup.
When I look at the trends, consumer durables for me is something which is a necessity and it is very basic. I look at cars are doing okay. I look at luxury sales which are doing okay. But when it comes to motorcycles and consumer durables, they are not doing okay. Why is that?
So Nikunj, I think a year ago it was largely inflation-led. I think for the last 6-8 months, it's because of the interest rate hikes. What happens with interest rate hikes is that your EMIs have gone up for most people, and their residual disposable income has gotten squeezed here. But like we've been seeing, hopefully we are at the peak interest rates. The governor just guided that
for sales through the financing route, and NBFCs and banks are now financing from a mobile phone to a fridge and a television. Why is that the financing route is not adding to the business uptick?
So firstly, to be honest, we don't play in those categories. Ours are smaller ticket size products, which are not typically financed. But that said, I think financing is part of the support system, but ultimately people need to have a certain level of disposable income. And tax has been squeezed significantly. Then, the psyche or sentiment on spending comes down. And I think sentiment often plays a much bigger factor than we understand. And therefore, I think this turn of cycle is important, because as negative news starts coming down for consumers, then the sentiment should start, becoming positive there.
The other, phenomena one is witnessing is that just about every consumer is now moving towards the luxury end, the premiumization end. Having said that, I don't see that translate into your premium brand, that's Morphy Richards. What's the strategy here?
So, Morphy Richards is on a different path. We are rolling out a new product portfolio for that, so we are perfectly fine with that. You'll see a lot more action on Morphy Richards second half of this year. So we've just been, waiting for that to play out, and we'll see that action play out.
How would you define competition in this space? First it was Chinese imports. Indian companies were getting Chinese manufactured products and selling them under their own brands. Now you've got companies like Reliance are coming out with their own line of white goods. What is exactly happening to the competitive landscape?
So firstly, I want to bust this myth around Chinese. Of course, some of the large white goods, panels, television screens, depends on Chinese imports. Almost entirely the small domestic appliances fans is domestically manufactured for a long time. So the Chinese imports or total imports is very, very small and insignificant in most of our categories. That's point one. Point two, competition is not new. It's been there for several years. At least I've been seeing it last 5 years that I've been in the industry that comes in. So I think we don't really react to competition so much. I think we have a clear path for us in terms of how we want to nurture or grow our brands. I think ultimately in the long run, brands will make a difference, brands along with product innovation. I do think, and while not naming the competitors, you named one of them, they will be price warriors. And that's not the segment or the price segment at which we want to battle at, or not definitely the strategy we are focused on. So there will be two products, commoditized players who will battle it out for price. We want to be a brand that's a brand of preference, and we have a different strategy on that.
So are you hoping that second half would be better than first half, or are you confident that it will be better?
I am confident that it will be better, yeah.
Okay, so then why are you confident? Is it because of the base effect, or you think that things will stabilize on the demand front?
So I think 2-3 points, right? Inflation has clearly plateaued out. Two, interest rates, which was a bigger negative factor, that has flattened out. So I think both of these with time will lead to better sentiment, and that should come back and start reflecting. Third is, like I just called out, the jobs data is to me the single biggest positive news that I've seen in a long time, and that has to translate to demand at some point of time. And fourth, really, as you get into festive quarter, unless there's negatives, people start, or they do have a propensity to spend. So I think hopefully, unless there's any further new bad news, I think you're gearing up for, potential tailwinds in Q3, Q4.
Anuj, great to have you on the show today and give us that perspective on where business is headed, and it seems like it's looking upwards for sure.
Thank you.
Still flat for the markets, not looking upwards for the index per se, but yes, a lot of bright sparks within the broader end of the market. Metropolis continues its uptake. HDFC Life has had a few good sessions all through last week. Today as well, it sees an uptake. There's Delta Corp, which has spurted up 4%. Birla Soft, Canfin Homes and Interglobe Aviation are all buzzers in trade. On that note, we're going to take a very quick break, but come right back. We've got lots lined up on the other side.